Good morning in Athens. Good afternoon, good evening to our host Asia on 5th in Singapore. Good morning to London, Athens, Europe. Presumably it's quite early for our American friends to join us. Congratulations for their President-elect Biden. First and foremost, I hope you and your families are safe and well in these testing times. Secondly, my thanks to all the staff at Asia on 5th for organizing this webinar, to Kate Ann, Angelia, and Big Adam Cotter. An exciting period for me, so you should correct this Adam there. A full 6-year term as Deputy Governor of the Bank of Greece came to an end a few weeks ago. So it's ex-Bank of Greece Senior Deputy Governor Adam. During this period, I had visit Singapore 4 times for speeches and lectures, twice as the final destination, twice on a day trip, transit to Australia and Japan. I hope all this pandemic nightmare is over soon and we all get together in real gatherings. A special hello to Philip Middleton and Dana in London. Philip is the director of the Digital Monetary Institute and vice president of ONFIF. Dana is the head of research, the chief economist. To my former colleagues at the Bank of Greece, Eli and Christos, the list is quite long, so I better stop here. Before coming to the ECB's Digital Euro report, which is half of our webinar today, published 2-3 weeks ago, one general remark, if I may, Adam, on the state of play of central bank digital currency, CBDC. Clearly, Asia Pacific in this frontier is ahead of Western economies, with China being the real front runner. With a superior digital infrastructure that facilitates and promotes a digital payments culture in the region, it's not a surprise that local central banks take the lead in developing and implementing either a real CBDC, like the People Bank of China, the e-yuan, also known as digital currency electronic payment that is tested these days in 4 big cities, or a wholesale one, the attempts by central banks, the Monetary Policy Authority in Singapore, in Thailand, other Southeast Asian countries like Malaysia, Philippines, but also Japan, South Korea. What we are witnessing here is a double race for central banks. The first is one between the official sector versus the private sector. Central banks got somehow themselves to be defensive, to be on defense vis-a-vis the private sector listed initiatives on the payment systems field. More and more people switch to payment platforms offered by big tech firms like Facebook, Amazon, Tencent, Alipay, etc. But also on their premature or infeasible plans to issue a private digital currency, Libra, etc. For central banks, such private initiatives are near to an existential threat. And the coronavirus pandemic, forcing more people to shop online using mobile phones, etc., has only added to this urgency. A retail CBDC could stem the growth of crypto assets like bitcoins and stable coins like the Libra, JP Morgan coin, etc., which pose numerous risks, including risks to AML, consumer protection, high volatility, and liquidity risk. Central banks instinctively are responding to the above private sector challenges by designing their own digital payments networks in order to retain control of their own monetary systems, forbidding at the same time any efforts to issue private digital currencies. It's a question, if you like, ultimately of monetary and payments sovereignty. As a legal tender, digital currencies should and must be issued by central banks. End of the story. Sovereign money is the winner in this race. I have no doubt about that, since the stakes are high. Having said that, of course, it's an open issue if national authorities, monetary and/or governments do something in either direction, either to promote or halt a big tech company dominance in global digital payments. The second race is among central banks. This is equally serious and with many facets. A few central banks may well be thinking about the issuance of CBDC, especially if they move first, as an attempt towards enhancing the status of their currency as an internal reserve currency. For instance, to increase its share in global trade, its share in the basket of global reserve currencies, and so on. If others go ahead with CBDC, it will be a strategic mistake for some of them to be left behind. If you like, it's also a reputational matter. Ultimately, it's a power game that may evolve into a new form of global currency war. What Stanford historian Professor Neil Ferguson called the new Cold War, with US and China as the two main rivals this time. What is at stake here is a US dollar hegemony as a global reserve currency. Of course, during the last decades, the international monetary system has lived with many types of traditional currency wars of the type of competitive devaluations. Even these days, with a global liquidity trap, with too low interest rates and that weaken national currencies, and the pandemic testing the limits of globalization, a number of analysts worry about an escalation of mega-enabled exchange rate policies. However, the new potentially global currency war we're talking about in the near future, for some already underway, is more subtle, more agile, and perhaps assertive. The most serious implication of moving away from the existing dollar-based international payment system with its traditional clearing and settlement payments to a new digital infrastructure with certain advantages, of course, to those moving first. There will be no need for electronic transactions to go through the existing international banking system for clearing and settlement. In that not-so hypothetical scenario, US dollar dominance will be diminishing with serious long-term repercussions in terms of its status as the world's only serious reserve currency. How likely is this scenario in the foreseeable future, the next 5 years, say? Well, nothing is permanent. The only permanent thing is change, according to the ancient Greeks. Clearly, though, US dollar global dominance will be at threat if it loses ground in the digital payments race, including CBDC. I now move on to the ECB Digital Euro report. The report examines the issues of CBDC from the Eurosystem perspective. The term digital euro denotes a liability of the euro system recorded in digital form as a complement to cash and central bank deposits. A digital euro would be just another way to supply euro, not a parallel currency. By definition, risk-free central bank money widely accessible on equal terms to users in all euro area countries. Fully trusted, just like any other form of euro. The report, I have to say, is rather thin on monetary policy implications of digital euro, and this is, I believe, deliberate. The ECB, all these big this at the executive board, they may have thought that we need to buy more time to see where things are going. There's no rush. After all, there are right now other urgencies for the ECB, like, for instance, the pandemic, the risk of deflation, the strategic review. By the way, Adam, if I can advertise something, next week with LC macro advisors, I talk about ECB's monetary policy, so feel free to join this. The report states, and I quote, monetary policy analysis could emerge in the future on the basis of further analysis. This is what I'll be doing, by the way, in the second part of this webinar, so please stay tuned. The report does not advocate a specific type of digital euro, ignoring also issues like running costs, setting up, etc. The main grounds that justify, according to the report, the issuance of a digital euro, they fall under 7 plausible real-world scenarios. I'll go briefly through this, and there are a number of implied requirements. First of all, related to the core central bank functions, scenario 1, the digitalization and independence of the European economy can benefit from a digital form of central bank money available to citizens. So this requires enhanced digital efficiency. The digital euro should keep pace with state-of-the-art technology at all times in order to best address the needs of all markets as regards usability, convenience, speed, and so on. Scenario number 2, the role of cash as a means of payment declines significantly. That won't happen overnight, but will take some time, of course. This requires a digital euro aiming to tap the decline in the acceptance of cash should permit offline payments. Moreover, it should be easy for vulnerable groups to use free of charge, of course, for basic use. Should have a strong European branding flavor and should protect privacy. Scenario number 3, a form of money other than euro-denominated central bank money, commercial bank deposits, or electronic money becomes a credible alternative as a medium of exchange, potentially also as a store of value in the euro area. So the digital euro should offer the basis for providing functionalities that are at least as attractive as those of the payment solutions available in foreign currencies. Scenario number 4, if the euro system were to conclude in the future that the issuance of a digital euro is necessary or even beneficial from a monetary policy perspective. In other words, digital euro is slightly more than another monetary policy instrument, and how this affects the transmission of monetary policy, the things we'll be talking in the second part of this webinar. Another scenario, scenario number 5, if there is need to mitigate the probability that the cyber incident, natural disaster, pandemic, etc., hinder the provision of payment services, then the euro system needs a backup system to improve the overall resilience of the payment system if we have cyber attacks, etc. So we need a sort of, an active backup system to support these eventualities. Now, related to the broader objectives of the EU, not necessarily specific to central bank functions, this is Article 127 of the treaties, the international role of the euro gains relevance as a euro system objective. In that scenario, of course, the digital euro should potentially be accessible outside the euro area in a way that is consistent with the objectives of the euro system, monetary policy, stability, financial stability, and so on, but also convenient to non-euro area residents. And finally, the euro system decides to proactively support improvements in the overall cost and ecological footprint of the monetary and payment systems. This requires cost saving and environmental sensitivity. The digital euro now should meet the following 7 prerequisites, irrespective of which specific future scenario materialize. 7 real-world scenarios, 7 prerequisites. Number 1, ability, of course, to control the amount in circulation. The digital euro should be an attractive means of payment, but should be designed so as to avoid its use as a form of investment and the associated risk of large shifts from, say, private money to digital euro. Number 2, understand the impact of the profitability and risk-taking of the central bank. In addition, the euro system must prevent to be exposed to financial liabilities as an operator of retail payment system. Number 3, the digital euro should then be made available on an equal basis in all euro countries through supervised intermediaries. Number 4, although central bank liabilities are not subject to regulation oversight, in issuing the digital euro, the euro system should still aim at complying with regulatory standards, including in the area of payments, perhaps because there is the feeling that it won't be the only game in town. It should be made available through standardized fraud-edge solutions throughout the entire euro area and interoperable with private payment solutions. Finally, the design should include specific conditions for access and use by non-euro area residents to ensure that this does not contribute to excessive volatility, capital flows, or exchange rates. The ECB high-level task force on CBDC will carry on work, and towards mid-2021, perhaps a short delay, the euro system will decide whether and when to launch a digital euro. That's all that I have to comment on the digital euro report. Perhaps we should pause now, Adam, as you said in the beginning, for Q&A, and then move on to the main area of my webinar, which is to see how the effectiveness of monetary policy, what's the impact of digital euro, and so on. Thank you.
Yeah, many thanks, John, and for giving us a very comprehensive start to discussions. And you're right, we should move on quickly. And though we are talking about the Euro system perspective here, I do want to go over to Aziz Durrani in KL, perhaps first before we go to any other questions. Because Aziz, I wanted to get your view in KL. John opened up with a remark about Europe possibly falling behind the curve in terms of central bank digital currency development. Do you think that's valid? And also perhaps for our listeners dialing in from Europe, could you share some of the key developments you're seeing in Southeast Asia and Asia more broadly in this space?
Yeah, sure, Adam. Thank you, and John, thank you very much for those comments. Certainly, I think there is the risk, and if you think about it, even kind of 2 years ago, the ECB was quite against the whole idea of CBDC and so on. So things have really changed, and certainly in Asia, John, obviously you mentioned the People's Bank of China. They're already quite far advanced with their CBDC project, and that's coming online. But we're also seeing a very high level of technological uptake. So it's not even the central bank currency. We have things like AntPay, WeChat. People are using these apps, GrabPay. So they're already used to kind of using virtual money in that respect, and therefore I think it's something that is increasingly being embraced by people in this region, and we're looking forward to it. And I think the other thing, John, that you mentioned at the start around the kind of the dollar dominance and the currency wars, or the silent currency wars, I think that's a very astute observation. That's certainly.
Do you buy this, my friend? Do you buy this? Do you think that things
yes,
will go there?
I think it's happening. Definitely.
Rather than economics, more politics than economics.
It is, but it is happening, and we can see the shifts as the major powers move out of holding dollars slowly and shifting to other currencies and so on. So these things are happening, and that's playing out. That's why kind of gold prices were shooting up as well, obviously driven by COVID also. But these are the underlying longer-term trends that are happening.
Just to build on that, really, I mean, do you think there could be a situation where the ECB's digital currency standards and sort of cross-chain payment systems could represent some sort of gold standard that other central banks around the world may follow? Of course, a lot of the standards that the Europeans are doing in the ESG space are being seen in that light.
Yeah, I think that there is definitely scope for that, and you're right with the ESG, with the data protection, GDPR and so on. Kind of Europe has been setting the standard, so there's the potential to kind of do that. My wider kind of question would be, just looking at the whole idea of cryptocurrencies, and for example, if we look at why Bitcoin came into existence after the last financial crisis, it was because of a loss of trust in central banks, and that feeling, especially now with the additional QE, with the negative rates, I think people still have that issue, and there's a worry that, okay, if we get into CBDCs, then that libertarian argument of potentially I can be cut off from a bank account if I disagree with certain policies and so on. However much we want to say that that's not on the table, it's going to be a worry, and that's going to be the bigger, I think, stumbling block that people will need to be persuaded on. So that's just kind of my overall thinking about one of the challenges we face.
Sure. Well, with the advantage of an ex-central banker, with my professorial hat now, I can say a few more things on this. Not in the immediate future, but who can tell in 10, 20 years from now? Danai is there. I can confirm this. That there was a survey, I think, by M50. Who you trust more, central bankers, or say the guy from Facebook or from Amazon? And people, as you expect, young people, these are familiar faces to them. It was half and half. But for over 30s, 40s, 50s, it was clearly trust is with central bankers. And we're not going to live for the next 20 years, hopefully, Aziz, and dear participants, with negative rates and QE. We have a strategic review of the Euro system, taking place right now. It's going to address all these things. But who can tell what the future will bring, say, 10 years from now? Clearly, the private sector see this, as a sort of, field to move into finance. Amazon and Facebook, this is what they have in mind, where perhaps, quick money is there. But having said that, and I think I mentioned this in my introductory remarks, it's a question of monetary sovereignty. Central banks will fight their corner, behind this, it's the state. So no matter, how rapid will be technological changes and advances, the state through the rule of law, it's there, to impose its ways. But it's one of those things that, and as I grow up and become more wise, I can't tell you, with certainty what will be the outcome. From now, the next 5-10 years, I stick with what I said, that central banks are going to win, official sector is going to win the private sector over this race. But, it's an open question.
And John, and maybe with your professorial hat on, I can ask you this question. I think it's fair to say the government of China certainly frames its digital currency as part of it, a sort of a great power competition it has with the US. I'm not sure if the US government has that same sort of view. But in this great power competition, where does Europe and the ECB's central bank digital currency lie? And also, if you want to perhaps comment on ASEAN or Southeast Asia's role in fitting into that as well.
Well, as you know, the euro is the second, global reserve currency. Of course, it's lagging behind to the US dollar. So to me, it will be a question between the two main rivals, China and the US. Europe will try, to position in this race the new Cold War that Ferguson mentioned this. And, presumably that's why, as Aziz mentioned, in Europe, they see that, if we left behind, then it will be a problem. It's Europe's independence somehow. But the way I see things advance will be a race between the two. Gradually, we will see this basket of global reserve currencies, Chinese currency to gain grounds on this. We've seen in the past, big currencies lose, esteem, etc. That's the challenge for the Europeans, by the way, to try to maintain, their share there in the global reserve currency. Of course, it's not only economics, as you understand. It's not only finance. It's also politics. That's why I believe Europe, needs to stand together and not lose big, countries like Britain, for instance. So the way I see it, it will be a rivalry between China and US, say, in the next 20, 30 years. And clearly, it's a challenge for the Europeans to maintain, their second, if you like, share in the global FX reserve basket.
Thank you, John. Aziz, feel free to add anything, but I understand if you'd rather not comment on that.
Yeah, I certainly think it's going to be a political issue as well, and so we'll have to see how that plays out. But I think the interest is also between the kind of the central banking side, the private sector side, and the interaction between that and how that wins out. And I think we saw just with the kind of current issue with Alibaba and their IPO and so on, that there is a lot of political considerations as well that have to be maneuvered through. I think the other question I had, John, and possibly you'll cover this in your second part, is more kind of, once we get these CBDCs coming in over the next 5 years or whatever the time frame is, essentially the role of the kind of the banking sector can disappear, right? Because that disintermediation is no longer needed. You get
about a minute. Yeah, sure.
Yeah. So I think that's also a big challenge that I'd be interested to
talk about, at some length about this. About it.
Okay. All right. Thank you.
Adam.
Great. Thank you, Aziz. Well, I'll just pause here as well to see if we have any questions from our attendees. Please do speak up. I haven't seen anything in the chat box. while we're waiting for people to either sort out their mute button, Raoul Herborg, of course, reminded me that, well, John mentioned it in his opening remarks about a study ONFIF had done together with G&D, the payments and cash note provider, on a joint study we do on central bank digital currencies and trusts in various countries. And the outcome was, of course, that people mostly trust central banks. So I'll just see if there are any other questions. If not, John, perhaps we can go back to you and move on to the main topic of conversation for today, namely monetary policy implications and financial stability considerations given central bank digital currencies. And then we will follow up with a short Q&A session after that as well.
Excellent. John. As I said in the beginning, ECB report is rather thin on monetary policy. So, let me say a few more words on this, offer my views basically, and give you also the professor's verdict towards the end of it. Just to raise your interest, I'll try then to answer the question, how big thing is this digital euro, digital currency in general, and how much is going to affect, the way we think and conduct monetary policy. But first, let me offer you the facts and my views before the verdict. Clearly, the introduction of CBDC is going to change the way you conduct monetary policy. CBDC represents a new type of central bank money whose demand, like cash, would need to be accommodated. CBDC would substitute other payment methods supported by banking deposits with ultimate effects on the money supply, since it may influence either monetary base and or the money multiplier. I'll say more about these things later on. Just to give you a flavor, just to give you an example, due to the existing fractional reserve banking system, the impact of the money multiplier may be triggered from, say, a switch from excess reserves to CBDC. So this is going to affect the denominator of the money multiplier. And of course, it's the effect how the currency deposit ratio will be affected, which appears in both the numerator and the denominator of the MM, the money multiplier, for the academics in the audience. CBDC could have potentially serious implications for the traditional business model of commercial banks, what Assis was talking a minute ago. This is so because if lending were to take place increasingly outside the traditional banking system, the role that traditional commercial banks play in the standard monetary multiplier process will be challenged somehow. This may in turn hamper central bank's ability to control liquidity in the economy through standard open market operations. More generally, a CBDC could be seen as a productivity shock in the financial system, altering the informational content of monetary aggregates, changing the velocity of circulation, and eventually, some people may claim, the stability of the money-inflation relationship from what is left, by the way, in this relationship. The relevant literature investigates the impact of CBDC through the existing 4 different channels of monetary policy transmission: interest rates, exchange rate, the credit channel, and the asset right channel. So the point is, what would be the impact of CBDC on, say, the money market rates, on the interest rates, the term structure of interest rates, including the effective lower bound, and of course, these days, on QE efficiency. I plan to make comments on all these things. Let me start with the interest rate channel. If CBDC is clearly, it's important here the distinction if CBDC somehow enjoys an interest bearing or CBDC pays no interest at all. The first somehow is associated with the wholesale CBDC. The second is with the retail CBDC. So let me start with an interest-bearing CBDC. This could make monetary policy more effective, perhaps, as the pass-through of interest rate changes by the central bank would be more direct and even addressing the zero lower bound. On the other hand, if CBDC offers a direct alternative for deposits, banks, commercial banks would have less ability to independently set deposit interest rates on how they do these days, capital shortages, risk profile, and so on. Last but not least, the CBDC interest rate would help to establish a hard floor under money market rates. However, the overall effects of CBDC on the term structure of interest rates are very hard to predict and will depend on many factors. To attract demand, short-term government paper and overnight repos with treasury collateral would likely lead to provide some yield pickup compared to the CBDC. This could lead to the short end of the sovereign yield curve perhaps being above the CBDC rate. In case now of unremunerated CBDC, non-interest bearing, like for instance banknotes, which I believe would be the case, by the way, this would not directly transmit changes in the interest rate to holders, nor it would be likely to have large effects on money market interest rates, but still would have huge implications for monetary policy. I explain. It could reinforce the lower bound on interest rates. The lower bound exists because if interest rates fell significantly below zero, depositors, there is this threat, could withdraw and hold banknotes. But doing so comes with some costs for money holders, particularly if we refer to large amounts, so there are problems of storage and so on. This makes the effective return on cash holdings slightly negative and has enabled some central banks to set policy rates below the zero rate paid on cash. CBDC would probably change that. CBDC would probably have negligible storage costs, making it easier to hold unremunerated CBDC when other interest rates drop below zero. So digital fiat can be programmed and people would have fewer fallbacks and central banks perhaps more flexibility. On the second channel, the asset price channel and the QF efficiency, my remarks are as following. A universally accessible CBDC would lead to a more efficient way to administer QE programs in general, with the additional liquidity to be distributed directly to the economy. Avoid, if you like, banks as intermediaries for that. The effect, if you like, at the end on aggregate demand hopefully will be bigger. For instance, CBDC could facilitate helicopter drops of money if we come to this scenario that could be used again to stimulate aggregate demand. Beyond that, as a liquid and credit-worthy asset and widely tradable, CBDC would be attractive to institutional investors that would be akin to interest-bearing central bank reserves or reserve repo facilities, yet could function as a safe asset comparable in nature, say, to short maturity government bills. CBDC attracting significant demand as an asset to hold may also change the structure and functioning of funding markets affecting banks and corporations. On the credit channel now, and the case of a remunerated CBDC, namely one that pay interest on CBDC balances, banks would have then less scope for independently setting the interest rate on retail deposits, would have less influence, if you like. The rate paid on a remunerated CBDC would set the lower limit for the return of households and businesses were prepared to accept on their money holdings. This may imply that as the rate paid on CBDC varied, banks might adjust the deposit rates offered to households and companies to avoid, say, a change in the relative attractiveness of CBDC to deposits. Ultimately, the impact, I'm afraid, will depend on the relative changes to interest rates on both savings and borrowing. At the end, there is clearly a downside risk here emerging with regard to the disintermediation that I mentioned before of the banking system by increasing the incentive for households and businesses to shift larger amounts of money into CBDC. There are, of course, solutions to this from the central bank point of view, putting a ceiling on these CBDC holdings and so on. This shrinking, however, of the banking sector's balance sheet, known as disintermediation, would result in a lower total volume of funding for banks. This is going to affect, also economic activity in the medium term. Of course, banks could react to this by paying a higher interest rate on deposits, offering also, a bigger package with mortgage, with overdraft facilities and so on. In a nutshell, that could result in a lower volume of lending by banks, all else being equal. It could also reduce the seniorage revenue, by the way, collected by a central bank, if this new form of digital money replaced existing cash. Seniorage, for the non-economist, it's also known, more popular, as inflation is a tax on money holding. So if there is less cash around the economy, this revenue from the central bank attributed back to the government will be much lower. Competition to deposit funding could be remedied, and bank disintermediation also could be prevented, as I said, by using taps, on holding of CBDCs, but also as Panetta, my former colleague at the Bank of Italy, now at the executive board, Fabio Panetta of the ECB, suggested a two-tier remuneration framework, and others also like Vincent and so on. The idea here is the following. The central bank sets a threshold on CBDC holdings, above which a less attractive and potentially negative interest rate is applied. Having a two-tiered system would bear some advantages over the one tier. First, the tier system distances the central bank from popular criticism on financial repression and so on. And secondly, the medium of exchange mechanism circulates as tier one. CBDC then too would be, as a kind of store of value. Finally, the exchange rate channel, we mentioned about this earlier before, so I'll be quite brief to give you my own verdict. This global liquidity, of course, people they expect will increase, may affect, the exchange rate parity, the bilateral or even the effective exchange rate. The cross-border and global dimensions of CBDCs available to non-residents could be especially pronounced during times of generalized flight to safety. Under such conditions, exchanging a CBDC for international currency could potentially enable faster deleveraging in capital markets. If CBDCs accelerated flights from risk, the deleveraging pressures could manifest themselves in the form of tight funding conditions. As a result, central banks that have introduced or seeking to introduce a CBDC should consider cross-border issues. In sum, the consequences of CBDC issuance for the implementation and transmission of monetary policy are directly related to how a CBDC is designed and how wide the access to a CBDC is. It could also raise questions about access to credit facilities of new counterparties to the central bank, for instance, from the fintech sector. And of course, all these things will have to be determined. And in addition, as we argued above, a digital fiat could change the composition and the size of a central bank's balance sheet and will therefore affect its profitability and risk exposure. Here is the professor's verdict on CBDC. Let me repeat.
Thank you, John.
Let me repeat the two questions I gave you earlier, Adam. Question number one: how big a challenge is the introduction of a CBDC? On this question, you have no doubt it's going to be an important structural change in the payment system and monetary policy fields, global liquidity and capital markets. If now this develops in 5 years to a regime switch, a game changer, this remains to be seen. Second question: how much will the way we think and conduct monetary policy be affected? On this second question, CBDC's parallel impact on the payment systems, FX global reserves and liquidity would force policymakers to a more holistic approach to monetary policy. If you like, it will force policymakers to move from a partial equilibrium analysis to a general equilibrium analysis, making so the challenge for them a more demanding one. One thing is certain: there will be no one-size-fits-all CBDC. As introducing a CBDC may bring huge potential to monetary policy, but also new risks and to new financial liabilities, including cybersecurity and so on. All this require careful assessment and consideration, what, for instance, the ECB is doing right now. Taking, of course, into account that new innovations, technological advances, do not always lead to superior outcomes. One word, Adam, on financial stability implications, and then you will open the floor for Q&A. Let me start with consequences for banks. We referred before to bank profitability. Of course, banks are going to fight their corner, you know. So I'm sure, you know, there will be a way that banks will be the major intermediaries of this. Of course, banks may opt, you know, to absorb this cost, so it's going to affect their net margins, or to increase the cost of borrowing. We'll see what will be happening, but banks will be there. I have no doubt that, you know, central bank can't be on its own. You need these commercial banks, you know, to transmit, if you like, the decisions taken by the board to the real economy. Another point is this: introducing the CBDC in a low interest rate environment could make deposits more prone to substitution, whereas in a high rate interest rate environment, the CBDC appears to be less attractive to households. Banks are also heterogeneous in the way they comprise their mix of funding. Deposit-intensive banks are more likely to be susceptible to the negative consequences of increased funding costs through deposits. One word on bank runs. The idea is that the CBDC may accelerate bank runs. It will be easier, you know, for households now to move to these safe assets through, you know, just press the button, the fastest figure first. And off the side, the risk here is that, you know, that the risk of a bank run, as depositors would easily be able to transfer bank deposits to the central bank. In other words, the stability of the retail funding could weaken despite deposit insurance, where the CBDC provides an extremely safe substitute. And of course, potentially, shadow banking may be affected. Some people claim that we see that, you know, shadow banking may play a bigger role. Well, I'm not sure about it. Last word about the consequences for non-bank financial intermediaries. Looking to the consequences for this, the impact is less clear and may depend on the level of substitutability of cash-like products in terms of liquidity and trust. In this respect, CBDCs could compete with money market funds, particularly in a very low rate environment. And money market fund customers would not be sufficiently remunerated for liquidity and modest credit risk, and prefer perhaps the certainty of a CBDC product. If this were to occur, it would have an implication on government, bank, and even corporate funding markets at the short end of the curve. Thank you very much for your patience, Madam and dear participants. Looking forward to your questions now.
Thank you, John. There's been some strong arguments there that these digital currencies, of course, are going to transform all the different aspects of the monetary system, but also possibly facilitate systemic and transparent, perhaps more systemic and transparent conduct in monetary policy. Now, I know we're running out of time, so I will just pause there for questions. Please do speak up if you have one. If not, I would like to pose a question myself, but I'll just give you a second to speak up. Okay, well, while we wait for questions to come in as is, I wanted to get your view.
You said the tone.
As is, perhaps just to get your views. John mentioned the issues around openness of economies as well, and I want to take a look at the release of the DCEP by the PBOC. Now, China is, of course, not an open economy, and in my opinion, there's no desire to open imminently in any way. But the Chinese digital currency is likely to be used quite heavily in the Belt and Road countries. And given its relative size to other countries along the Belt and Road, do you think this is an area of concern in terms of financial stability?
I don't think it would be an area of concern for financial stability per se, because at the end of the day, it's just moving on from using the yuan or whatever in physical sense to a digital. So in that sense, whatever conditions were there before will remain. It just might be that it becomes easier to do it that way, and therefore, becomes more de facto the way of doing things, and hence spreads in that manner. So, certainly I think that's the way it's going. But, there's also other countries in this region. Cambodia, for instance, have just recently launched, it's not a full CBDC, but it's certainly a digital means of payment, which is showing that they've kind of really come up the curve quite quickly. So I think, one of the other positives of this technology is it does give countries a quick way of scaling up and getting past a lot of the problems that may have their populations may have had. It could create other problems in terms of if there's no physical currency, does everyone have access to mobile phones or computers to be able to use these kind of digital things? And I think the other bigger question is also around cybersecurity, because a lot of people will be new to this. There'll be a lot more scams going around, and there's potential for your accounts to be hacked into and so on. And that's another question, perhaps, where we've got to think, if those kind of things are happening, will the central bank be able to stand behind and compensate people, or at what level do they say it's your own risk or whatever? So those are kind of big questions as well.
Thanks.
If I may, a short comment, staying in the region there, in that part of the world, what is interesting, of course, what will be happening to the other safe haven, Japanese yen, as a result of this, currency war or rivalry, and of course in Europe in the Swiss franc. So it's not only euro, that perhaps there is this risk to be left behind.
That's very true. Now, we do have some questions coming in. We have one here from Rahul Herborg. Rahul, do you want to speak up and ask your question?
Hi, Rahul.
Yes, hello. I'm happy to do so. Rahul Herborg from G&D. John, thank you very much for your great insights regarding monetary policy. My question would really be what you mentioned. Obviously, there are many topics to be analyzed in detail. And what is the approach from you and the ECB, how to address these open topics, how to analyze them in detail?
Well, there's this high-level task group. They wrote a very, very fine report. The forward is, itself by Fabio Panetta, who is the chair of this task group, but also by President Lagarde. So clearly, there is a strong signal there that the ECB is taking seriously, this new potentiality. It will take some time, if you ask me, to see a digital euro. Not saying the next 3-4 years. There are other priorities, but as I said, if other central banks they move forward, then this is sort of putting extra constraint, say for the ECB, to move also in the same direction. To me, and I would like to hear the views from other participants here, is crucial, how, say, the wholesale CBDC, what treatment will have. For instance, there will be an interest rate charge on this. That will be close, say, to reserves, or the retail CBDC, if it will bear interest rate, or will be just cash, just like banknotes. These are, questions that need, more careful consideration and analysis to be raised, because this is going to affect not only the transmission of monetary policy, but also implementation. So it will be a sort of, wait and see approach in some countries. Let's see what others have been doing. But having said that, there is a clear, advantage here of moving first, at least in terms of the currency war that we talked before. Thank you, Rob.
Thank you, John. Aziz, do you want to add anything on that, or anything on the first mover advantage?
Yeah, I think certainly there is that first mover advantage potential that people are trying to get into to drive the credibility and so on. But equally, it comes with its own challenges because the first mover can also fall into some problems and so on. And so sometimes it's kind of a bit of wait and see is fine to ensure that the technology is up to it. But I think, yeah, there are concerns around how you kind of support a retail currency. How would you kind of frame the reserves for it? And again, as I was saying, if we're still having, if banks are playing the role that they are at the moment, then I can't really see, okay, you can credit their reserves, they then become an intermediary more than anything else. So I think their ability to kind of create new money could be, that may not be required if it's happening straight from the central bank, which then brings in the question that does the central bank want to get that involved in the whole process, or at least be directing it, even if it's still the bank making those credit decisions at the other end. So there are some, yeah. So I was just going to say, yeah, there's some fundamental questions there that we still just need to consider, because like many things, there could be consequences coming out of it that we may not see up front, but could only later start posing an issue.
Great, thanks, Aziz. Now, of course, the pandemic this year has demonstrated how interconnected the world is, and this takes me on to a question from OnFIF's own Phil Middleton. Phil, would you like to pose your question?
Yes, I hope the bandwidth holds up. John, we can see, as you said, not one size fits all. We're going to see a lot of different digital currency experiments within national borders to support different national policies. How do you see all these various CBDCs being regulated and made interoperable globally? I mean, we have enough trouble with Basel for capital requirements. How are we going to do it for digital currencies?
Well, you said yourself, that it's the BIS there, the banks, to look at this issue, that will be the natural, body to regulate this, together, of course, with the FSB. And because I'm happy that you agree that it's not going to be only one CBDC, it can't be, even within national borders, then clearly, unlike cash and banknotes, there's an issue there of regulation and supervision. So there's a huge area there, a new area, by the way. Bank capital, as a result of this, may be affected if bank profitability, is going to be reduced. So, clearly there's lots of work there for supervisors too. The focus today, of course, is on monetary policy, a few operational issues, but clearly, the challenge is there also for supervision. There's no doubt about this, Phil.
Thank you, John. Aziz, I'm not sure if you want to add anything to that.
Yeah, I guess just to add, in terms of different CBDCs as well, at the moment, if we have a, say in the UK, we saw Brexit coming, for the everyday kind of person on the street, there's not that much you can do. Clearly, high net worth individuals could move out of the pound and go into the dollar or the Swissy or euro, whatever. But once you have these CBDCs available more freely, you could just say, well, I don't want pounds, I want to swap into my global account and go into another currency quite easily. And that in itself could be one of those consequences that we may not have thought about, but it could create some instability in itself. So that's also something else to consider.
Sure.
Thank you, John. Perhaps we can just have time for one more question. Please do speak up if you have any. Well, in that case, given we are now at our allotted time, I would like to thank both John and also Aziz for joining us today and sharing their time. It's great to have two very great thinkers joining us today. So thank you very much, both from ONFIF, but also the attendees joining us. I think this issue around interoperability and some sort of integrated framework is going to be something that develops very interestingly over the next years to come as well, especially given how the situation or relationship between China and US develops. So we'll be looking at that very closely, of course, and the role of Europe and ASEAN within that will be something we'll need to discuss more at depth as well. But I'd just like to say thank you again for the organisers, and thank you to John in Athens and Aziz in KL.